Okay, all right. So chapter 5, although it was not tested for the midterm exam, make sure you take some time to watch the video or do some practice questions. I think chapter 5 quiz is due today, but I want to help you guys with some kind of relief of your pressure. So I consider chapter 5 quiz as a bonus mark, okay? So you don't lose anything if you are too busy to do it, right? So you don't lose anything. But for those of you who wants to do it, this is a bonus mark. The deadline, I think, is tonight at 10 o'clock. Okay, just keep for your information. Chapter 6 is about inventory, okay? So inventory, I think in the intro financial accounting, we have talked a lot about inventory, okay? I know I taught 2100 at Lethbridge, the campus. So I know that we spend a lot of time on this topic. So I hope that you will find it relatively easier for this chapter when you look at all these concepts that you should be already familiar with, okay? So chapter 6, inventory. I'm showing this picture because I took this picture. I thought it's pretty cool. Okay. So when we were doing some auditing work, we do have to count the inventory, right? So we are doing, one of our clients is a First Nation. So they have, we have to go to the native reserves to do their inventory count on their cows, okay? But the cows is everywhere, right? So we had to drive around the native reserve, right? Just count all the cows. Like it's spread everywhere. It's kind of a quite interesting experience, counting animals as part of the inventory procedure. Okay, so the learning objectives. You have learned about perpetual versus periodical system, right? That's the two types of systems for inventory control. So we're gonna talk about the differences, okay? And we also want to know, okay, what should be included as part of the inventory. So what is the inventory cost? What cost, what types of cost, what amount of cost should be included in the inventory? And also, we want to know about the different method of allocating cost between inventory and the cost of sales. You are familiar with this, right? Remember, we talked about FIFO, right? First in, first out, weighted average, right? Those are the different methods when we are calculating cost of goods sold, right? So essentially, we know the total goods available for sale, right? So the your beginning inventory level plus the purchase you made for the year. So that's the total. The total amount is the amount of goods available for sale. And then you're going to allocate this into the two categories, right? The cost of sales and inventory, ending inventory, right? And then number 4, we're going to talk about, this will be something new, okay? This will be something new you haven't learned. So we're going to talk about evaluation, whether and how much inventory should be written down, okay? And I think this is something should be pretty intuitive. If you carry an inventory for too long, right? Very likely, you have a hard time to sell this item. Maybe the fair market value is down, right? So you can't sell it at the price you want. You have to write it down, right? So that's the idea that you have to evaluate whether the inventory items should be written down, okay, and by how much, right? By what amount? And number 5, we're going to talk about it. What is the relationship between the income statement and the balance sheet? So it's interesting, right? So what items in the income statement, cost of goods sold, and what items is on the balance sheet, ending inventory, right? So we want to see about how when there's an inventory error, what's the implications on the two financial statements, okay? So that's kind of the learning objectives for this chapter. For most of the part, you should be already quite familiar with. So hopefully you'll find it's relatively easier in this chapter. Okay, as I mentioned, for any balance sheet items, Okay, I'm talking about balance sheet items. They are the permanent account items, right? You have 3 stages, right? So initial recognition and subsequent measurement and derecognition, right? So that's kind of the life stage for any balance sheet items, right? So we want to understand all the relevant implications in terms of accounting at each stage, right? You know, initial recognition, subsequent measurement, and derecognition, okay? So I probably will show this picture to open every chapter, okay? Because we are talking about ISIs, right? In the following chapters, and they all kind of balance sheet items. So this is kind of the framework we are using, right? The 3 stages: initial recognition, subsequent measurement, and derecognition. Okay. So you all know 2 different systems: perpetual versus periodical system. Okay, so let's take a closer look at these 2 different systems. So for perpetual system, so what happened is for perpetual systems, they monitor each transaction, okay? So when you sell an item, okay, let's say you sell 5 units of maybe like pencil boxes, right? And so then the systems recognize this reduction of 5 units in the pencil boxes right away. Okay, for each transaction, you are scanning the code bar, right? Your system know right away that my inventory level of the pencil boxes is down by 5 units. Okay, so they directly keep track of the addition, okay, or withdrawal from the inventory. Okay, and so basically, you can expect how much inventory left, right? So in the beginning, you have 20 pencil boxes, right? And on Thursday, you sold 5, okay? So then you would think you should have 15 units left, right, on hand, right? So that's the idea. You're keeping track of the inventory additions and the withdrawals. Then you would be able to predict the level of the inventory, okay? And you also know the cost of goods sold, right? How much the cost of goods sold for the 5 units of the inventory, right? In 2100, we practice a lot, right, with this journal entry, if you remember, right? In the midterm final exams, there's one question you have to calculate, right? What is the cost of goods sold? And then the question is, do you need to perform inventory at year end? Do you need to perform inventory count at the year end?
Yes.
Yes, you need to perform inventory counts at the end because you need to confirm the quantity reported and then the actual quantity that is available in stock.
Yeah, thank you. Yeah, exactly. You still need to perform inventory count to confirm the quantities, right? So in the beginning, it's 20 units. So Thursday, I sold 5. I think I have 15. But guess what? When I counted, there's only 14, right? You wonder maybe somebody just stole it, right? Maybe one person just walked away with it without being caught, right? So by doing this, you can confirm the quantity, and also you can identify the shrinkage, right? You can identify the shrinkage. So that's the perpetual system. The periodical system, the major difference is that under this system, they have an account called the purchase account, okay? Called the purchase account. So under perpetual system, there's no such account called the purchase account, okay? So as soon as you saw this, purchase account, you know right away, this is a periodical system, okay? So basically, this account will capture all the purchases during the year, okay? And for each sales transaction, you do not record cost of goods sold, okay? So you save that until the year end. You are making only one entry for the total amount of cost of goods sold for the whole year. How are you going to do that? You're going to perform a inventory count at the year end, okay? So remember this inventory equation. So you use your beginning inventory, okay? That's how much you have at the beginning of the year. And you add the amount of purchase during the year, okay? That's total amount of inventory available for sale. And then you counted how many left at the year end. That's your ending inventory. So then the difference is your cost of goods sold, right? The difference is your cost of goods sold. And so then you only make this entry at the year end after you perform the inventory count, okay? For the perpetual systems, for each sales transaction, right? Even you only sell 5 pencil boxes, you recognize, I debit cost of goods sold, and you calculate what's the cost of goods sold for the 5 units of pencil boxes, and you credit the inventory, right? But for periodical system, you only do 1 entry for cost of goods sold, and you save that until the year end after you perform the inventory count. Okay. Do we have any questions in terms of the differences between the 2 systems?
No.
Why would you not always just use perpetual? Is it not more accurate?
I think perpetual systems, you can see there's more works, right? In terms of you need to have a sophisticated system, right? Inventory system. And you need to have a lot of transactions, right? Because you are keeping track of each transactions. You record your cost of goods sold, right?
So just the costs
aren't
offset.
Right? Yeah, there are more work in terms of under the perpetual system. And also the system, maybe the inventory management system, maybe not every business have it. I think big companies like Walmart, they should have this kind of system, right? The inventory management level. But for smaller operations, companies, they probably cannot afford sophisticated systems like that. So then what they do is they may just do an inventory count, at the year end. Yeah.
Okay.
Good question. Yeah. Anyone else?
What industries usually use the periodic system?
I don't have a good answer for that. Yeah, I'm not sure. I'm not really sure what it would be if the industry matters. I don't know. Yeah, maybe I'll look for it for you. Yeah.
I got another question. Which of the 2 systems is generally more used in the world?
Which one? I thought that if you read the textbooks, they did talk about it. Did they? I can't remember, but I remember when I read the chapter 6, there are some information about in terms of the percentage of usage. Do you mind check it on the textbook? See if there are some information on this?
Yeah, I will have a look.
Okay, awesome. Yeah, but it's a good question, right? It's a very good question. Can I move on?
Yeah, I think you're good to go.
Okay, so let's take a look at the journal entry. Okay, let's take a look at the journal entry. So in terms of this example, so suppose the beginning balance is 200,000, and the purchase during the year is 700,000, and the ending balance is 300,000 in the inventory. Okay, this is just one example. So let's take a look at the key account. Right, this is the inventory is eyesight with a normal debit balance. Okay, so all the increase has to go on the left side, the debit side, and the decrease, the withdrawal, has to go to the right side. So your opening balance is 200,000, and when you have addition, right, you increase inventory, so you put it on the left side. So that's the 700,000. Okay, your ending balance is 300,000. So then you did this calculation. So 200 plus 700, so 900. That's how much available. So 900 available at the year end. There's only 300. Okay, so now I know that I sell 600, right? So that's my cost of goods sold. So you can see this is the periodical inventory system, right? This is the periodical inventory system. So you use the inventory equation, beginning balance plus purchase minus ending inventory. That's your cost of goods sold, okay? I think this is pretty straightforward, right? I don't have to talk more about it. So let's take a look at the perpetual inventory system. So for perpetual inventory system, similar idea, beginning 200, purchase 7, ending balance 300. And over the year, okay, they keeping track of the cost of goods sold. And they found out that the amount of cost of goods sold is 500. Remember, they keep track of every transaction, and all these transactions add up to be 500,000 cost of goods sold, right? So then you wonder, okay, what happened, right? So 200 plus 700, 900, minus 500, that's 400. My ending inventory should be 400. But when you do an inventory count, it's 300. So what happened for the 100? So then you identify this is a shrinkage, right? Maybe theft, due to theft, okay? 100,000. Okay, so do you see the difference now? Okay, you see the difference now?
Yes.
Yeah, okay. So what is important is both systems will show the same ending inventory at the cost of goods sold. Okay, so it doesn't matter which system you use, okay? At the end of the day, you should have the same amount of cost of goods sold and inventory. Okay, here, your ending inventory is 300 under both systems, right? And your cost of goods sold is 600 under both systems. So it doesn't matter which system you use. You should end up with the same numbers. Okay, does that make sense?
But isn't periodic much better? Because then it looks like perpetual, there's more theft.
So in the periodical inventory, so the theft is the same, right? Because the fact that your items is being stolen has nothing to do with which systems you are using, right? But in this case, you are able to identify the amount of the theft, the amount of the shrinkage. By the way, right?
I have a
Yeah,
question.
I have a question.
Okay, go ahead.
Yeah, so if for the perpetual, it is updated as the year goes by, how come you are determining the cost of goods sold for $100, which is as a result of which is a shrinkage as a result of theft? How come it's at the end of the year that you are determining the figure? You should have determined that figure in the course of the year.
Yeah, at the end of the year, I would expect, right, before the inventory count, I predict my ending inventory should be 400 because I have 900, right, available. And according to my record, I sold 500. So I really should have 400 left. And then I perform the inventory count at the year end. I realize I only have 300. The only reason for the difference of 100 is because the shrinkage, right? So that's why I book this entry here. Does that make sense?
Not quite clear.
Pardon me, does that make sense?
Yeah, not quite clear, but because I'm looking at if it updates as the year goes by, unlike the periodic. The periodic is the one that should have this kind of issue, such that it is at the end of the year that you have to determine how much is lost to theft, and not perpetual. In my own opinion, anyways.
During the year, you will not know, right? During the year, if you don't do an inventory count, you will not know whether there's a theft or not, right?
Oh, okay, yeah, now I get it.
If you don't do an inventory count, you don't know, right? Unless you start counting your items, you don't know you are losing items. Yeah, and that inventory count is a very time-consuming procedure, right? You don't want to do it too often, right? Think about the Walmart. If they shut down the entire store, do inventory count, that's very costly, right? They probably only do it once a year. I don't think they would do more frequently, right? What's the point of doing that? you can't stop people stealing items by doing more inventory count, right?
Hi.
Yes,
it's
go ahead, Carla.
I just had a quick question. Is it someone asked what type of industry would use a perpetual?
Yeah.
And I was wondering if like maybe like an art gallery or something that is just doesn't sell a lot of items, so then it's easy to track, or like how do you decide? I guess that's what I'm not sure.
Yeah, that's a very good point. Yeah, I think you're absolutely right. If you are considering certain low volume,
Yeah.
high value type of industry, they probably use perpetual inventory system.
Yeah, right. Because it wouldn't be such a pain, and
Yeah.
you have more control, I guess, right?
Yes, very
Okay.
good. Thank you.
Perfect.
Very good point, Carla. Thank you. Anyone else? Can I move on?
Yes.
Yeah.
Okay, awesome. So now you see the difference, right? But make sure you understand, doesn't matter which system you are using, you should have the same end results. So your inventory, your ending inventory is the amount of the, according to the inventory count, right? And your cost of goods sold, is the beginning plus purchase minus ending inventory. Okay, in terms of journal entry, under perpetual inventory system, when you made a purchase, you debit the inventory, right? Because these items you purchased increase your inventory. Those are the additions. You debit the inventory, credit the cash or accounts payable. So during the year, right? Whenever you sell one items, you recognize a decrease in inventory. You credit inventory, and you debit the cost of goods sold. Okay. And after the inventory count, you have to reconcile, right? You have to reconcile to figure out, right, what's the amount of the inventory shrinkage. So you credit inventory for the amount of the shrinkage, and you debit the cost of goods sold. Okay, does this make sense?
Yes.
Yeah, okay. Under periodical system, when you purchase, you have an account called a purchase account. So debit purchase account, okay? For 700, credit cash or AP, 700. So then, you skip all these transactions entries, right? It has nothing to do with the periodical system. And after the inventory count, right? So you're gonna close your purchase account, right? So at the year end, okay, the balance of purchase account is the amount of purchase you made throughout the year, okay? So at the year end, you are going to close this account. So you credit purchase for 700, okay? And now you want to see what is the change in the inventory level. So your inventory in the beginning is 200, in the ending is 300. So your inventory increased by 100, right? So in the increase, you have to debit inventory for 100, okay? And then you need an additional 600 debit. You debit the cost of goods sold, okay? Does this make sense?
Not quite.
Okay, what's the question, Daniela?
Just for the inventory of 100, I'm not sure about that.
Yeah, so the opening balance of your inventory is 200, right?
Yeah.
And you want your ending inventory to be 300, right?
Uh-huh.
So you have to increase it by 100. So 200 plus 100 equals 300.
Okay. Thank you.
Yeah, okay. Anyone else?
I have a question.
Go ahead.
So between perpetual and periodic, why for purchases in perpetual you debit inventory, but for periodic purchases?
So remember, the perpetual systems directly, okay, keep tracks of the inventory level, right? So that means whenever you have addition or you have withdrawal, that all comes through inventory account. Because they are keeping track of the inventory level, right?
Okay.
Yeah, so when you have a purchase, your inventory level increased. So that's why you debit the inventory, okay? And when when you sell something, you credit your inventory, right? Because your inventory decreased. Okay, so you are always using inventory count so that it's monitored, right? The level of the balance.
Okay.
For periodical system, you are not directly monitoring the inventory system, right? So it's just easier. It's just easier to have a separate account, and then to capture the total amount of purchase, and then you close it at the year end, right? This is much easier from the accounting perspective, right? You just have a purchase account. Whenever you make a purchase, all that goes to the purchase account. At the year end, you close this account. Okay.
Okay. Okay. Thank you.
Okay.
Sorry, I have a question.
Go ahead.
When it comes to auditing the two different inventory systems,
Yeah.
is there different techniques used, or essentially one, like you could just audit that both systems the same?
Good question. Yeah. So the auditing on inventory is basically on the balance sheet with basically your inventory count, right? So because at the end of the year end, right, you are showing your inventory level on the balance sheet, right? The question is, are you overstating your inventory? Do you really have all these items you claim to have, right? So what happened is the auditors has to go to audit this inventory level, okay? So it's quite interesting because I have done this work. So basically, they will print out an inventory listing for you. So you, as an auditor, I randomly selected a bunch of items, okay? I will not do the whole thing, okay? If I do the whole thing, I will never have the audit done, right? So I have to do some testings. So basically, let's say the total balance of the inventory is 1 million, okay? And I think the risk level is low, okay? The inventory risking level is low because the company is having a very good system monitoring the inventory level. So then I will be just happy to check maybe 10% of the value. So I'm going to only check 1 million times 10% would be $100,000 inventory. So then I will pick some large value items. I will pick some low value items, right? And the total value will add up to be 100. And I randomly selected all these items, okay? And then I will go check, okay? So I will show up, on the day, right? So I want to see, okay, show me this item where it is, right? And so the manager will walk me around to show me, okay, here is the 10 tubes, okay? And then I will check the inventory listing, and I will check the price, and I will count it. I will physically count it, how many tubes have. So regardless which type of systems, the key is about, is the inventory count correct, has been done with faithfulness, right? The ending inventory level. So I have done an inventory audit for a company. They sell all these tubes. They sell all these tires and stuffs, right? In north side of Lethbridge, and their year end is January 31st. Okay, so that means I have to be there. I remember it was a snowy day, right? It's a storm. It's really bad, but you can't cancel that appointment. You have to do it on that day, right? Inventory count. And so then I went there. Then a lot of items is outside. So they have a large yard, okay? So they have a stocks of lots of items outside. So it was really a tough job. So me and the manager, we had to just count, like there's 100 tubes, right? And then I counted 99, and he counted 100, and then we had to count it again, right? So yeah, it's a tough job when you do auditing on the inventory. It's quite boring, but anyways, from the auditing perspective, it's mainly about the ending inventory level.
Okay, thank you.
Yeah.
Sorry, one more quick question.
Go ahead.
So
Tim.
you said on the periodic system, how do you catch the theft part?
You can't,
like,
right?
Cannot. Okay.
Yeah. So that has nothing to do with accounting. Whether you can catch the theft has something to do with your control system, right? So if you go to the clothing store, right? If you go to Winners, You go to some of the, the retailers selling clothing. They have to figure out how to prevent theft, right? Maybe they will put like this, I don't know how to say, this clip, right, on the clothes. If you walk away, that thing's gonna beep, right? Things like that. So that has nothing to do with your accounting systems. You have to, came up with certain maybe controls. You install cameras, right? To monitor, to make sure you have cameras everywhere to cover all the corners, and so what happened? Oh, okay. So when you are going to the fitting room, right? They will give you this card, right? This plate showing the number of clothes you bring into the fitting room, right? I'm not sure because that's my experience. If I picked like 10 clothes, right? I want to use the fitting room, they will give me like a plate, right? 10, right? And so then they know that how many I bring in, something like that. So yeah, it has nothing to do with the with the accounting system. It has to be their whatever their ISAT safeguard system, cameras, maybe different electronic devices. Yeah, so they have to be smart. Depending on how serious the problem is, they may have to invest in very sophisticated systems. Yeah.
Okay. Thank you.
No problem. Yeah. Well, to me, that plate thing is quite expensive, right? Because you think about it, for every clothes, you need to have a person to physically attach the clip into the clothes, and then when you check it out, you have to remove the clip, right? So that, to me, that takes a lot of time, right? It's all money, right? So maybe the theft is a very, very big problem for the clothing industry, the retailers. They have to spend money to invest in this type of control, right?
I have like a follow-up question.
Okay, go ahead.
Like, how about shrinkage? Like, do they have a separate process to calculate the shrinkage if they're using a periodic system?
So basically, how many items has gone through the proper procedure, has been checked out properly? Because you think about it, these items can leave the store only in two ways. Either has been checked out properly through the proper through the counters, right? Or it wasn't checked out at all. So the only way you know is to do inventory count, right? So you know how many I have in the beginning, and then how much do I have now? Okay, so the difference is basically how many inventories is gone. And then if you use a perpetual system, and if that number does not agree with your calculation, that means there's theft, right? That's the only way you can calculate it. Otherwise, how you can know it? You won't know, right?
Okay.
Yeah.
Great, thank you.
Yeah, you could capture some theft. Maybe the camera, in one occasion, some people was trying to stealing something, and you capture it, right? But that doesn't mean you can capture every situation, right? But the thing is, if you capture it, it's not considered as theft. You didn't lose it, right? If you capture it, it's not a theft anymore, right? Because it's not a shrinkage anymore. Shrinkage is only the items that you didn't capture it, right? Sometimes it's funny. Did you see some kind of empty bottles when you go to some grocery stores? I found it was really funny to see those. So how come there's empty bottles? So two theories, right? One, somebody bring their own drink. They finish drinking and they are lazy. They didn't take it with them, right? Second of all, they pick up a juice, a bottle from the store, and they maybe hide it somewhere and they just drink it. Yeah. So they didn't take it away, but they finish it in the store, right? So those will be a theft too. Yeah. Maybe cameras can capture it sometimes, maybe not.
I have a question as well. Yeah. Hello.
Yeah, Claire, go ahead.
Oh, so what's the consequence if the inventory goes wrong? Seems we do a physical inventory audit twice a year. Seems for us it's a big event. Before the auditor comes,
yeah,
we content a couple times to match their inventory report.
That's right. Yeah. Yeah, for sure. You do the inventory count. It's a big job. It's definitely a big job, and you should be ready for the auditor to come, right? A lot of things you need to prepare. So in the later slides, I'm gonna talk about it. How about consignment, right? You know, the auditor go to your warehouse. They want to know which items belong to you, right? You may have, there are maybe some items does not belong to you, right? You are a consignee, right? You holding the items for other people. So then auditor wants to know, right? You don't add these items into your inventory, right? So auditor will ask you, okay, you know, where are those? Do you have any consignments, right? Where are they located? And do you have any items that has been sold but not picked up yet, right? Because you sold those items, it's not yours anymore. So you have to segregate those items in a designated space, right? So auditor wants to know, right? These items should not be included in your inventory, right? So those are the areas subject to error. So auditors right away will want to ask about these questions. So the accountants has to be very cooperative, right? In terms of they have to know everything. They have to be really ready. Yeah. Does that answer your question?
That's one case. So what I meant is if during doing the inventory, the process, we made some mistake and the auditor catches the mistake.
So then it's between you and the auditor. So for example, it's cold outside. I counted 99 tubes and the manager counted 100. What are we gonna do, right? So then we count it again. Okay. we count it again.
Okay, what about the report says only maybe 98?
So then maybe both of us are wrong. So we had to deal with this until both parties are satisfied. Okay.
Oh, okay.
And so maybe when I count it again, it's my error. Maybe it is 100, right? You know. So basically, there is a reconciliation between the auditor and the manager and the company's manager about how to deal with this, right? You know, sometimes it's funny, right? Maybe it's not 99, it's 99.5. Okay, so somehow the long tube, right? They cut it into half. Okay, it's not the standard size. So then what are you gonna do? You'll be like, okay, can you sell it? First of all, you're gonna ask the manager, can you sell it this half size? And the manager, oh, no problem, I can sell this. I can sell it for half price. And then you can use 99.5, right? If they cannot use it anymore, then it's 99, right? So it's quite interesting, you know, when we're really doing our inventory count. Yeah.
Okay, thank you.
Yeah, no problem.
But then in such cases, I don't think it's a reason for you to qualify your report.
Yeah, exactly. You have maturity, right? Yeah. I'm not sure. I don't want to talk too much about auditing because some of you haven't taken the courses yet. So, but the idea is what is material, right? And so if there's only like one disagreement and a very minimum dollar amount, we probably don't care, right? It's $20, right? So the manager was very kind. I showed up without a tube. It was really cold. So the manager gave me a tube, okay, with their company's name. And then I'm thinking, is my independence was challenged? Right? Is this a self-interest conflicting here? And the tubes maybe only worth $5, right? So, and I was a new auditor. I had to talk to my audit manager. And he said, oh, that's okay. It's only $5. Your independent judgment is not impaired. So don't worry about it. Just take it. It's too cold outside. Okay, so I should move on, okay? So initial recognition and measurement, okay? So what should be included in the inventory? So IFRS, okay? So 2, okay, refers all the cost of purchase, okay? So if you buy something, you know, that's a purchasing cost. That should be part of the inventory cost. cost of conversions. If the items you purchased is not the end product, right? So you have to incur certain costs to make it better. So for example, if I have a business, right? Just for example, I will find some really cheap KGG items, right? I find some second-hand furnitures that are very in bad shape, right? So I paid the money, so that's my purchase cost, right? So that should be part of my inventory cost. And then I had to paint it because this second-hand furniture, I bought it, they don't look nice, right? So then I have to make it look nicer, right? So I had to paint it, right? I have to polish it, right? Maybe I have to carve it. You know, I'm an artist. I have to carve it. So all these are considered as conversion cost. You make your items better, right? So then those costs, the cost of the paint, the amount of the hours, my labor hours, the labor cost, right? Those are the conversion costs, right? That all should go to the cost of my final inventory item. And other costs incurred bring inventories to your present location conditions, right? If I'm buying an antique furniture, it's very heavy, it's hard to move. I have to hire a company to move it for me, right? So you know, those costs, shipping costs would be all considered as part of my product cost, right? Purchase the goods, purchasing price, government tax, right? Government tax, GST sometimes, shipping and handling cost, and other costs to bring product to location. This all should be included in your inventory cost. Subsequent cost, right? For example, you pay for retail space, you rent a retail space, you pay for the salespersons. Those costs has nothing to do with the goods, right? With the inventory. So those are not inventory. Those costs should not be included in the inventory. Okay. And also goods in transit, right? That's something you want to consider. At what point do you take the legal possession of the goods? That's important, right? At the cutoff point, do you own this goods or you do not own this good? So we call it free on board, FOB, free on board. This is the point at which the buyers take legal possessions of the good. So the two common ones are shipping point, FOB, shipping point. So you take the possession as soon as this items is loaded onto the truck at the shipping point. You owned it, okay? If you purchase the eggs and if it's FOB shipping, if the truck was in an accident, all the eggs was smashed, too bad, that's your egg, right? Because it's FOB shipping, right? If it's FOB destination, you took the legal possession only after you know, the items, the goods reach the destination. Okay, in that case, the risks when the goods are in transit is still on the seller. Okay, the buyers does not take the risk. So make sure you know the policy, right? What's the policy? Is that FOB shipping point, or if it's a FOB destination point, right? So you know, that's quite different, right? In terms of you know, the cutting off point, right?
Sorry, I have maybe it's a stupid question, but I'll ask it anyway. When it comes to like shipping, like from overseas, is that going to be FOB destination, or which one is commonly used when?
I think it's a contract between. It must be a contract between the buyer and the seller.
Okay, so
because who's gonna bear the risk when the goods is in transit, right? I think that's the question.
Okay, so I'm just asking. Okay.
Yeah, I mean, sure, you may prefer always. For example, if you are suppliers for Walmart, right? You may prefer like FOB shipping point, but what Walmart wants to ship FOB destination? Well, definitely, Walmart has more negotiation power, right? So do you want to do business with Walmart or not, right? maybe it's preferable for you to have FOB shipping, but maybe Walmart will insist on FOB destination, right? So I think it must be written. It must be like must be agreed by the two parties, right?
Okay, so it's just a contract basically that matters.
Yeah,
it's not about
and who is going
overseas or whatnot.
Yeah, and who is going to pay for the trucking, right? For the truck shipping cost, right? All these things, I mean, it's probably part of the negotiation, right? I don't think there is a, a industry common practice everyone has to follow. I'm not sure. I'm not aware, at least, that's the case.
I can help a bit on there. So
Thank you, Ali.
I've handled an export business before, and Wei-Ming is right. So it will depend on the preference also of the buyer. So like some of our buyers who are based overseas, they are importing a lot of goods, and therefore they have like global contracts with these shipping companies, and they can get preferential rates versus us, the exporter. So sometimes whoever can get the freight cheaper, then they will prefer to have it at FOB.
Okay.
Thank you.
Thank you. Okay, so any questions about what we talked about so far?
So it's only between like large companies, not like little customers like me. Like when I buy something from Amazon, if I don't get it, I can report something.
Okay, I think for Amazon, I think it's FOB destination.
Yeah.
Yeah. So you only take the legal possession when the items reach your door. Yeah. Because otherwise, you don't have the legal possession, right? Yeah. If something lost, it's Amazon's problem, because Amazon is dealing with the shipping companies.
Okay.
Okay. Another question. It fits to what she just asked. What if Amazon delivers to your doorstep, and then you weren't around, and then it got lost at that point? What happens to you?
If you just talk about Amazon specifically, Amazon is having really good customer service. Even you got the items, you don't like it, right? And you can still return it, right? You may have to pay for if it's a product issue, it's free. You just, they will pay for the postage, right? If it's because you change your mind, you can return it by paying, a postage, right? So so maybe I didn't really understand your question. Do you mind to rephrase your question?
Yeah, what I mean is that if Amazon delivers the package to your doorstep, and at that time you weren't at home to receive the package, and then one way or the other you got back and then you couldn't find the parcel in front of the house, what happens? Do you claim the packages back, or what happens?
So that I guess I'm not sure. This is about maybe between the postal office, the delivery. So in certain items, they need your signature, right? They will not deliver to you. So Pure Reader or some other, I'm not sure about Canada Post, but for Pure Reader, if they requires your signature, you are not at home, they will give you a notice. You have to pick it up at their store, right? For sometimes Canada Post just drop the items in front of the house, they will take a picture of that, right, as a proof. So yeah, I don't know what if somebody steal your items.
Well, I shouldn't be asking you that question because you don't work with them. So,
pardon me?
I said I shouldn't be asking you that question.
Okay.
Because you're not in the best position to answer the questions. This is just for a lecture, anyways.
Okay. All right. Yeah. Okay. Anyone else? Okay, we'll keep going. Consignment basis. So you should not include consigned goods in the inventory, right? Because another party wants to use your warehouse, right? Your space to display their items. So you do not own these items. It's not yours, right? Remember, to be your inventory asset, the definition of the asset is the control, right? You have no control over those items. So these items are not assets and they are not inventory, right? You should not include consigned good in your inventory, okay? Manufactured goods, okay? This is the 2400, okay? So I trust all of you have taken the introduction, what is called introductory managerial accounting, okay? You should all have learned about this manufacturing goods stuff, interesting stuff. So basically, I'm just quickly recapture some of the things. So production involves conversion of raw materials to finished goods. So you could have three basically inventories. You have raw materials inventories, okay, and you have working in progress, right? Working in process, right? So basically, this is the items that you have already have spent labors on those, right? And then you have finished goods inventory. This is the inventories capturing all the goods that has been completed, right? So you have three inventory levels. So this production process involves labor, machines, other resources, right? So then the cost of using these resources will be considered as part of your product cost, okay? So any cost directly related to the production, that's called the product cost. So, and any cost is not directly related to the production, that's called the period cost. So if you are renting a building, okay, you are renting a building, and that building is for the admin peoples, okay, not for the factories, not for the working factories, right? So then that's the rent for that building is a period cost, because the cost is for admin people and not for the frontline workers. So it's not directly related to the production. So therefore it's called a period cost. Okay, so so normally the product cost will be included in the inventory cost. The period cost are not included in the inventory costs, okay? So the period costs are expensed on the income statement, right? The product costs are captured into the inventory on the balance sheet. And overhead, fixed overhead. So for example, the factory rent I talked about, right? Those called overhead. What is overhead? If it's not labor, if it's not raw materials, right? And this is the cost necessary for your production, but it's not raw materials, it's not labor. You call those costs overhead, right? If the amount is fixed, has nothing to do with the level of production, so you pay $5,000 factory rent regardless how many units you produce. Those are fixed overhead, right? For fixed overhead. Okay, so the question here is fixed overhead considered as period cost, okay, or product cost? If you think it's a period cost, it makes sense because it's fixed, right? Because just like people's salary, right? It's a fixed. If you think about the product cost, it's the factory rent is related to the production. You need the factory building to for the production, right? So in that case, we have two different costing system, variable costing versus absorption costing. Under variable costing, okay, under variable costing, the fixed cost, overhead cost, is considered to be a period cost. So that runs through the income statement. Under absorption costing, okay, so the fixed overhead is considered as product cost because you need the factory for the production, right? Without this fixed overhead on the factory rent, you are not able to produce, right? So therefore it's product cost. So depending on the costing system, if you use absorption costing, fixed overhead is considered as a product cost. If you are using variable costing, it's considered as a period cost. you have taken 2400. You know all this, right? Do you know? Do you still remember all this stuff?
Yeah.
Yeah?
Sort of.
Yeah.
Okay. So I'm not going to spend time to recapture the course, right? I'm just quickly refresh, your memories about this. So if you take a look at the differences compared to costing system, variable versus absorption, the only difference is how they treat fixed overhead. Under variable costing, they treat fixed overhead as period cost. Under absorption costing, they treat fixed overhead as product cost. Remember, product cost will end up on the inventory, right? And period cost will run through the income statement. Okay, so what's accounting standards say? Managerial accounting internal decision maker favor variable costing, right? It's because it's easy, right? I'm not sure if you remember some of the questions. Variable costing is easy to deal with when I do the calculation. Do you remember that? Maybe not, that's fine. So it's easy to use, right? In terms of calculations, right? It's relatively easier to use. But IFRS and ISB, okay? IFRS and ISB require absorption costing, okay? Why? Because the matching principles. You do need to have this fixed overhead for the production, right? And then for the revenue. So matching revenue with expenses, okay? So the IFRS and ISB, they require absorption costing, okay? So when you prepare year-end financial statement, according to IFRS and ISB, you have to use absorption costing. But for internal reporting, right, for quarterly reporting, for the purpose of the managerial decision, you could use variable costing, right? It's easier for the managers to perform the calculations, right? Okay, so there are some accounting issues under the absorption costing, okay? Okay, absorption costing, depending on the production level, okay? If the production level is above the normal level, and that's one scenario, versus the production level is below the normal level, okay? That's two scenarios, right? So suppose normally a company will produce every year 1,000 units of an item, okay? We consider this as a normal production level, 1,000 units. What happened if the company produced 2,000 units, okay? So that's the first scenario, when the production level is above the normal, right? 2,000 is above 1,000, right? Well, when you produce more, right, it doesn't mean you can sell more, right? The sales part is the demand from the market. So you still sell the same amount of items. So you ended up have a large ending inventory if you overproduced, right? So you're gonna have a relatively larger ending inventory, okay? So then what happened is this larger ending inventory will absorb a large proportion of the fixed overhead, okay? So then the amount of the fixed overhead goes through the income statement will be lower. Your cost will be lower. Your income will be higher, okay? So if a manager wants to manipulate the earnings upward, they could overproduce items, okay? They could overproduce items, right? They just want to have a lot of inventories, ending inventories. So the ending inventories can absorb the fixed overhead cost, okay? And less costing runs through the income statement, okay? And so if the production level is lower than normal, it's the opposite. It's the opposite. So do you understand now? Overproduction is a way of the management earnings management. Okay, so that's my quick capture of 2400. Okay, does anyone have maybe questions or quick comments?
I have a question.
Go ahead.
Okay, so does it mean that these two methods will produce different gross profits?
Sorry, can you say that again?
So because you said that the absorption costing categorizes fixed overhead under product, so that means they will go through the cost of goods sold, right?
Yeah.
So does it mean that if you use absorption costing, the gross profit you would get will be different from the gross profit you would get under the variable costing?
Oh yeah. So basically, what happened is eventually, right? Eventually, the ending inventory has to be released, right? Eventually, you have to sell those ending inventories. So whenever the ending inventory is sold, the cost ended up in the income statement, right? So if you make the earnings looks better this year, but next year the earnings will be worse, right? Will be very, very bad because the ending inventory will be released, right? It absorb the cost in current year, but whenever you sell these ending inventories, that cost will be released to the income statement, right? In terms of cost of goods sold. So they are only shifting the cost across the different reporting period. Okay, so if you have less cost in this period, that means you're going to have more cost in the following years.
Okay.
Yeah, gross profit margin. So that's calculated by sales, right? Minus cost of goods sold. That's your gross profit, right?
Yeah.
Yeah. So you can manipulate your gross profit 1 year to make it look good, right? Higher, but then your next year's gross profit will be lower. Because this year you are overproducing, right? So you have a large ending inventory level that absorbed a lot of cost, right? So then your cost of goods sold is lower. So your gross profit is higher. But next year, when you sell all these, when you sell all these ending inventories, those costs will be ended up in the income statements, right? So cost is cost, right? Expenses is expenses. So you have to recognize it. It's just a matter of time. If you did not recognize it this year, you have to recognize it in the future years. So next year, the cost of goods sold will be higher. Your gross profit will be lower.
Okay.
Does that make sense?
Yes.
So just remember, cost is cost, right? Eventually, everything has to go through income statements, right? Think about it. When you sell your business, right? You know, you have the business. At the end of the day, you have to sell your business, right? So everything has to convert it into income, right? that's why business is there for income, right? And you recognize the cost for earning the income, which is expenses, right? So if you really think about the life of the business, it's all about income, expenses. Eventually, all the balance sheet has to be converted. Eventually, when you sell your business, right? When you sell your business, all the balance sheet items is converted into revenues or expenses, right? So it's only a matter of time when you're going to recognize the expenses, right? If you somehow use this trick to report less expenses in the first year, okay, but the following year is going to be higher cost. Remember, it's accrual based, right? It's accrual based. It's really about the allocation across the different reporting periods. Did you learn this in 2400? I think you should have learned this in 2400. So in 2400, you should have a question like this. In 2 years, right? In 2 years, so the first year, you report a lower cost of goods sold. But the second year, you report a less cost of goods sold. Okay, and in the end, in both situations, the total cost of goods sold for the 2 years is the same, right? Did you do work on problems like this? I think you should have done that.
I don't recall this in
No?
2400, but it's okay. Learn it. It's all good.
Okay.
I don't
Any other
remember
questions?
either.
Sorry, Alina, can you say it again?
I just said I don't remember.
Okay. So maybe it's not me teaching 2400. Somebody else teaching 2400. Okay. So I'm gonna. Are we okay with this? Can I move on? So I'm gonna